Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. This episode is all about small caps and big returns. We've got Jordan Zinberg on the show of Bedford Park Capital. He traffics in a very interesting part of the market, only Canada. He doesn't look at resources. So you might think that's too small to focus on, but he's had some massive returns. His fund last year was up 60%. But it does mean you have to weather some volatility. We're going to find out his highest conviction ideas. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is brought to you by BMO Investor Line. We often discuss various stock ideas and market trends on the show. If you're looking to explore those ideas further, BMO Investor Line is an excellent source. Their platform provides in-depth research, powerful tools, and commission-free trading on over 100 popular ETFs. Plus, you'll find the BMO Investment Learning Center with educational resources and videos empowering you to make informed decisions. Remember, always do your own research before investing. Learn how you can earn up to $3,500 cash back when you open a new account at bmo.com/online investing. Jordan Zinberg of Bedford Park, thank you so much for joining me.
Thanks for having me.
So I think you're no stranger, especially to the people watching this podcast. People know your investing style. It's sort of small and mid caps, but I still think it's worth exploring because you're not the typical like TSX 60 investor. You're not owning BCE or the banks. You're not trafficking in the Mag 7. So what is your bent?
So we focus exclusively on Canada. And as you said, within Canada, specifically on high quality, small and mid cap growth stocks. And we're not resource investors. So unlike a lot of Canadian small cap funds that are maybe a third or half resources, we're not really playing in that part of the market. So we're focused on a very specific corner of the market. And as you said, it's somewhat of a unique approach amongst Canadian small cap managers.
It's such a slice of a slice, right? Because when people do go small caps, you're absolutely right. They tend to traffic in resources because we've got a ton of that. So like how big is the market for you? Like how many options are there to invest in this area if you're going to be small caps X resources?
It's bigger than you think. If you look at our target market cap, which is about 100 million to 5 billion, we end up with about 700 or 800 names. And of those 700 or 800 names, we have a database where we track about 250 of those. And then from those 250, we eventually end up with our portfolio.
So what does it take to get in the fund?
It's a very high bar. And part of the reason I say that is because what we're looking for is so specific. That's the first hurdle. And then secondly, we tend to own a lot less names than I think you'd see in most funds. So we're currently sitting at 17 stocks in the portfolio. But even taking that a step further, it's not 17 stocks equally weighted. We tend to have most of our capital in our top 10 ideas. And that's the way I've always felt comfortable managing money. And the thinking is, I don't want to have capital in my 40th best idea, ever. And I don't think our investors want to have their capital in our 40th best idea. And if you meet me and you think I'm good at what I'm doing, you probably want most of your capital focused on only my best ideas. And that's how I try to run the fund.
Is there a common theme in your best ideas?
No, it's actually a pretty eclectic portfolio. I was talking to somebody we deal with on the institutional side recently, and he said to me, your fund, he said, no fund looks like your fund. So we were having that conversation.
Well, I guess that's good. You're not going to get closet indexing with you.
No, and listen, it works both positively and negatively. But I think we tend to be positioned more as the high octane or torque piece of a portfolio. So people will have, if they have fixed income or they have, private credit or whatever they're doing on the income side, and then on the equity side, they'll have their US large caps, they'll have their Canadian large caps if they're Canadian investors. But there is a space, and I think a lot of investors tend to ignore small caps. And there is a space probably for about 5 to 15% of a portfolio where it can make a big difference. If you have a year like we had last year, or the year before, even a 10% allocation in your portfolio could really drive your returns from, high single digits into the double digits.
Well, if you won't say it, I will. Your year last year was nearly 60% returns. Is that right?
Yes.
So that trounces large caps. It trounces the small cap index. I want to know how it's doing in 2025 because this is kind of a rough year.
Yeah, and I think to put it in context, let's start with last year and then we'll come to this year. So last year we had the TSX up, I think 20-ish%. Bank stocks were up 25%. The NASDAQ was up, I think 30%. So last year you could have really done anything and made money. And the way that our fund's positioned is in the good years, we should do much better than the market. And that's what you saw last year. And then in a year like this year, where the markets have been shaky, our investors don't expect us to be up in a down year. For that, they'll use things like market neutral, they'll use different strategies. So for us, obviously, when the markets are down, we're going to be down. Sometimes we'll be down more than the market. And that's a risk that we accept in order to get the upside. You're getting enhanced volatility both ways.
So I know you're such a fundamentals person. You rarely look at the macro. I'm still going to ask you a macro question, though. Do you have to consider things like tariffs, things like fund flows, people maybe just dumping the sector? Because often with small caps, as you said, it can just be starved for capital, and that can be a lid on share prices.
Sure. So you said a lot of interesting things in your question. So we can go a lot of different ways with that. I think small caps, if you look right now, they're trading at a historical gap valuation-wise to large caps. It used to be that small caps, if you go back into the data 15, 20 years ago, small caps would always outperform large caps. And then there started to be this disconnect, I think, with indexing and with all the trends that we've seen in the market lately towards, let's say, Mag 7 or the other things you mentioned. So the interesting thing is we don't actually need small caps as a group to do well. We just need to go in and find 10 or 15 companies that can outperform. So getting back to macro, I think you have to have a view. You can't just turn your brain off and say, I'm not paying any attention to macro. We pay little attention to it. I think the context for us is, where are we in a cycle? Are we at the beginning, middle, or the end? How aggressive do we want to be? We're not really thinking about sectors. So I'm not saying, okay, we're at this point in the cycle, and usually industrials do well in this time, so we're going to go find some industrials. I don't do that. That's all top-down investing. What I want to do is I want to lay all the companies in Canada out on this table right here, and based on my criteria, say, these are the 15 we want to own.
You also rely, I guess, on maybe new issues coming to the market as well. IPOs are a litmus test of where we are in the market. And boy, there's just been a dearth of them in the Canadian markets. Does that matter to you? Wouldn't it be nice to get some of those fresh ideas out into the market?
Sure. I mean, we saw that huge rush in 2021, which brought us some companies that we own today. Right now, the window is closed. There is just no IPO activity in Canada at all. And even just financing activity in general outside of mining, it's been extremely quiet this year. I don't really rely on that extensively for new ideas. Obviously, if there's a new idea, I'll look at it, and we're always turning over stones and we're always looking at new things. But I don't think I've bought an IPO since 2021.
All right, well, let's go find where there is some activity. We'll dip into the mailbag and get into some of the viewer questions. Okay, our first question in the mailbag is GoEasy. What are your thoughts on GoEasy's new CEO, and why was GoEasy able to land arguably someone who would have been or could have been an heir apparent to run Scotiabank? What is the book value for GoEasy, and why is it trading so close to it? This one coming from Jeff in Toronto. Jeff sounds like he's done his homework on GoEasy. What's the backstory? What is GoEasy? What's the play here?
I could probably talk about GoEasy for the entire podcast. I know that's not what we want to do, but I've been following this company for over 15 years. For those who don't know the company, it's a Canadian non-prime lender that has slowly expanded in the non-prime lending market in Canada. And they started off with, it actually started off as a rent-to-own furniture business, which they still have today as a division. And what happened was, over time, they started providing financing to their customers who were renting furniture and appliances. And eventually the lending portion of the business grew much larger than the rental business. And it sort of morphed into this extremely high quality, profitable non-prime lender.
And when you say non-prime, they're basically, these are people that may not have the kind of credit that can get loans or financing through a bank. And typically they're charged a much higher interest rate for that.
That's correct. So in Canada, the banks will deal with the prime credits. And then players like GoEasy will come in and maybe someone's had an issue with their credit, or it's a little soft, or maybe they're new to the country, or maybe they're an entrepreneur that doesn't show all their income in a traditional way. There's a number of reasons why a person might go to a company like GoEasy. So they do installment loans, they do lines of credit, and then they've expanded the business into auto financing a couple of years ago with the purchase of a public company called RIFCO, which you might remember from Alberta. And then this year, and this is important in the context of the second question about the new CEO, they're expanding into credit cards. So if you look at the segments of non-prime lending in Canada, you really have installment loans and line of credit, you have auto, and then you have credit cards. It's about a third. It's a $200 billion market. So GoEasy, despite being around a long time and all their success, they're just getting into this massive credit card piece right now. So it's going to be pretty transformational for the company.
So the new CEO is Dan Rees, and so that's where you think he takes the company.
I think that was definitely one of the reasons they went with him. Just to be clear, I haven't met him. I don't know him. I did do some channel checks with some friends at Scotia. The feedback came back very positive. I have to say that when I first saw the announcement, I was a bit surprised, just given the type of company that GoEasy is. I wouldn't have expected them to pull somebody from a bank. I actually thought they might pull somebody from a US lender. I was quite surprised with the choice, because what can happen sometimes when you have these entrepreneurial finance companies that aren't banks, and I've seen it before even on trading desks, where they bring in somebody from a bank and they say, oh, well, I'm going to turn this into a bank. And all of a sudden, the risk people take over, and all of the entrepreneurial spirit and risk taking that you saw in the business actually start to go away. So I was a little bit concerned when I saw he came from a bank, but then when I saw what he actually did within the bank, he wasn't your traditional banker. He wasn't an investment banker. He ran several different divisions. And I can tell you that the management at GoEasy is fantastic. The current acting CEO is the former chairman, David Ingram. We had Jason Mullins, who was the former CEO, who I had a very good relationship with. This is a company that has been one of the top performing stocks in Canada over the last 20 years. And a lot of people don't even know it exists, but they've returned 20-ish% over 20 years to investors. So
it's down a little bit in 2025, and I wonder if that's a fresh opportunity to buy the stock, and if one of the reasons it's been vulnerable is because of tariff risk, because of associated job losses and risks when it comes to credit losses. So I know you don't look at macro, but it seems like, is macro weighing on this stock?
Well, so for this name, it's actually quite relevant, because as you pointed out, the number one driver that you look at for credit performance is employment. Believe it or not, the second one is oil prices, I believe. But it's interesting because there's a lot of misconceptions about how these non-prime lenders actually function in a bad economy. And I've seen this watching GoEasy. And actually, BMO's analyst put out a great chart on this. I think it was last week, where he looked at peak and trough multiples on GoEasy. We saw a huge drawdown in COVID. We saw a drawdown when Alberta was having some trouble a decade ago. And what tends to happen is, instead of trading at 11 times earnings, which is the long-term average, we see it go down to about 6 times earnings. And that's what we're seeing right now, because, as you say, the natural thing to think is, oh, the economy's slowing down because of tariffs, people are going to lose their jobs, unemployment's going to go up, and credit performance is going to suffer. Now, the flip side to that is GoEasy actually has a lot of secured loans now because of some acquisitions they've done and because of the nature of the way they've changed their business. Almost half the book is secured. So that's the first part. The second part is, when you think about a GoEasy borrower, these are not usually people who have jobs that are very hard to replace if they leave. So these are not people that are typically CEOs of companies where it might take them a year or two to find a job. These are typically jobs where people can move quite easily and get a job again. So they might lose their job, but it's easy for them to come back. The last piece is, when you get into a bad economy, what do banks do with their credit policies? They tighten them, right? So what ends up happening is you get someone who might have qualified for bank financing before, who no longer will, and now slips down into a lender like GoEasy. So intuitively, you wouldn't think, but what ends up happening is you get better quality borrowers that slip down to the non-prime lenders, and credit performance. So GoEasy actually had their highest credit score ever amongst their borrower base in their last quarter, believe it or not.
So you mentioned that BMO report, they upgraded the stock to buy, citing some of this valuation stuff. They say it could be a $200 stock. It's trading at around $150. I know you don't do price targets, but how do you think about the upside?
Well, we can in this case because it's really easy. So let's just think through the math. Right now, their loan book's a little over $4 billion. They've come out with 3-year guidance, which, by the way, they never miss their guidance. If you look back, they're always updating fresh 3-year guidance every January. They don't miss. Their earnings run rate right now is probably about $23, $24. I think once you get to that $7 billion loan book, you've got about $30 a share in earnings. So let's do the math. So if it typically trades at 11 times earnings, once they get to that $30 a share mark, you've got a stock that's over $300. And actually, I think there's a target on the street from Beacon that's in that range, about $300. Even if you look at current earnings run rate right now, on a normalized 11 times multiple, the stock's probably about 220. So if you don't own the stock, we already own a lot, so I'm not buying it here. If I didn't own the stock, I'd be buying it here. But if you look at the chart, you'll see these drawdowns that I spoke of, and then you look at the long run returns, they're still in that 20% range. So despite having these couple drawdowns every 3 to 5 years when you get these macro events, as long as you don't do anything stupid and hold on to the stock, you've done extremely well. In COVID, the stock went down to $25. It went from 150 to 25. And you know where it went from there? It went from 25 to 220 over about an 18-month period. So you had a 10x off the bottom. So if you own it, hold it. If you don't own it, I think it's a great time to buy it.
Let's move on to McCoy Global. This one is smaller cap. I think it's sub $100 million market cap. Makes equipment for oil and gas.
They do. And actually, they were just in my office last week. So I got a great update. Not very well known on the street. There's only one analyst covering the name, I believe, although they are trying to change that. The company's been around for a long time. This is a classic example of an underfollowed, ignored, extremely high quality company. They're a global business, so they sell all over the world. They're a tech-driven oilfield services business. And the reason I say that is, we've been doing more in oilfield services lately than I've done in a long time. And part of the reason for that is there's a huge wave of technology coming in.
So you said you're not a commodity investor. So this investment has nothing to do with your call on oil prices?
No, I'm not making a call on oil prices. I'm just looking at a very high quality business that happens to be in oilfield services. And to your point, it's really hard to be a Canadian equity manager and not have any exposure to resources. So one of the ways we get a little bit of exposure is through the service companies, both on the energy side and even mining services as well, because those are really more like traditional industrial businesses. So you will have obviously commodity driven type price spikes as the commodity goes up and down, but it's not going to be as severe as, let's say, if you owned a producer. So it's a way to tangentially play resources and have some presence because when the resource market rips, if you're a Canadian manager and you don't own resources, you're going to be behind. So we have been doing quite a bit in OFS. And as I said, there's a wave of companies that are really tech driven, which is bumping things like recurring revenue. It's bumping margins. I'm seeing margins in some oilfield services companies that I've never seen before. You'd normally expect, let's say, a 30% gross margin. And if you're lucky, maybe a 10% EBITDA margin or something like that. We're seeing companies with 40% EBITDA margins and 60% gross margins. So things that you just wouldn't see in OFS. And so McCoy specifically, they focus on a very specific type of technology. And what they're doing now with new products is they're giving E&Ps the ability to monitor what's happening down in the wells remotely from anywhere in the world, 24 hours a day. McCoy specifically has no debt, so they're net cash. So they've got a really nice balance sheet. They are buying back stock. They just announced recently an automatic share purchase program. I think they bought back their full NCIB last year, so they bought back 10% of the company. I top picked it on BNN at $2. I think it's trading, in and around that kind of low threes now. We got up to $3.50 a couple of days ago. The company was marketing last week, and I think some people got excited. It's got a dividend. It's got a clean balance sheet. You're going to see more recurring revenue. And I think on my numbers, you're at about 6 times next year's earnings right now.
Yeah, there can be a lot of risk, I guess, associated with the sub $100 million market cap company. But those are metrics like they pay a dividend. They're doing their full buyback. They trade at 10 times earnings.
6 times.
6 times earnings that you might not typically see.
Well, and this is what's exciting about the small cap portion of the market, though, is you can, if you know where to look, find these really high quality companies that are growing, that are well managed, and you can go in and buy them at low multiples. And what ends up happening over time is as the company grows, you have different pools of capital that are able to come into the stock. So there's a group of investors that might come in at around 100 million market cap, and then you get another group around 250 or 300. Actually, the TSX put out some data on this about a year ago, which I thought was really interesting, just sort of what levels investors tend to come in. And obviously once you hit 500 million and $1 billion, and then you get multiple expansion. So that's when you do really well in these stocks and you put up years like we put up last year, because not only are you getting the earnings growth, let's say the company's growing the earnings at 15 or 20%, you're now getting the multiple going from 6 times to say 10 times.
So you think this company can hit those milestones? Like it could be a $500 million company?
That would take some time. Just we're going off a pretty low base.
Yeah.
But do I think the company can easily make investors 20% a year? And that's really what I'm looking for. Is I'm looking for companies that I think can make me 20% a year consistently. Things that can double in 3 to 5 years. That's what I'm looking for, and I think this company can do that. And we've already. I mean, we came in at $2. The stock's trading low 3, so we've already captured a couple of years of those 20% returns in a year.
But you see more upside.
I do. The stock's cheap. If it was trading at 16 times earnings, we'd be having a different conversation.
Okay, now we have to talk about Payfare.
Sure.
We got many questions on Payfare. This one coming from Reddy Wilson on X. I lost big on Payfare. We should backstory this. Payfare is no longer a publicly traded company, right? It was bought by Fiserv, and I think that deal closed in March. But it imploded last year. And I think that, how big of a holding was this for you?
It wasn't a top 10 holding, but it also wasn't, a bottom holding. So we had probably about a 4% weighting in the stock.
So Payfare provided payment solutions for gig workers. Like if you were a DoorDash or Uber driver, you wanted your paycheck sooner, Payfare would make that happen. And then they lost DoorDash as a customer and the stock tanked. What did you do about that?
So let's back up. So the business model itself was actually very, very smart. The first time I sat down and actually understood exactly what they were doing, I said, wow, this is a really interesting business. It's really scalable. And I think if you look at what's going on more broadly, this whole gig economy is really becoming very significant. I think when you look at especially the younger generation now, some of them don't even get their driver's license. They just take Ubers. A lot of them, even if they're looking to go to McDonald's and it's 5 minutes away, they'll still order it from Uber. So I think
will take a 3-minute Uber drive to work.
Yes, absolutely. Some will. So I think if you look at the gig market, it's growing really, really fast. The data is probably about 25, 30% a year. So that part was interesting off the hop. And then this model specifically worked very well because a lot of the drivers didn't want to wait 2 weeks to get paid. So I really like the business model. The one risk we always had was DoorDash was a huge proportion of their revenues.
Like 70%.
Yeah, 60, 65. They didn't actually ever give us an exact number. We knew that risk going in. I think the messaging was always that DoorDash didn't want to do this themselves. And I think what happened was over time, as they saw the margins that Payfare was earning, they realized maybe they could internalize this with a partner. The partner that they ended up choosing ended up actually buying Payfare, which made it even more interesting. Needless to say, I think, we were pretty vocal on the stock. We liked it. Here's where the difference comes in between watching me on BNN and being an investor in our fund. So we bought the stock at around $2 in the fund. I probably didn't get to talking about it on BNN until $4 or $5. I think it went up to about 7 or 8 at its peak. Then they lost this contract. It went back down to 3 or 4. We ended up selling the stock in the low 4s, and then it got taken out, I believe, at 5. So we actually did quite well on the stock. But the average person who might catch me on BNN and then not see me on BNN for 6 or 9 months, they don't know that we're selling the stock. So it's great if people want to cherry pick our ideas, that's fine. But knowing when to buy and sell is actually very important as well.
Well, that's why you come on In the Money now, because you can tell people that they got to give you a call directly if they want to get that access. But was there kind of is this just what happens? Did this moment really shake you, or was there kind of a teachable moment from this, and now you're going to apply that to other issues in your portfolio?
Did it shake me? No. Was I happy when I came in that day and saw the news and saw the stock down 70% in one day? No. This is why we own multiple names. And this is also why we have a very specific trading system that we use in terms of sizing our positions. So we do take relatively large positions. Luckily, this one wasn't that big.
And is it because you saw that as a big risk? They have big exposure to one customer?
That was a risk. The other thing that kind of held me back on it was the stock wasn't really performing as well as I would have expected it to. And we have a style that, let's say the numbers are really good, but the stock's not moving. Even if I think it's the best thing I've ever seen, I actually won't add to the position. So a lot of people will say, oh, well, you bought it at 10 and it went down to 8, so you should buy a lot more. We never do that. If I buy something at 10 and it goes to 8, I'm not adding, because there's either something I don't know or there's information out there in the market that I don't have, or there's a reason nobody else wants to own the stock, and I don't want to be piling capital into a stock for 6 months or a year that no one else wants to own. I don't want to be the one pushing the stock higher. I want to be there early, and I want to let others push the stock higher.
This brings up, obviously, Payfare was kind of bought out of distress by Fiserv that is ultimately going to be using their technology, probably with DoorDash, who kind of caused this situation. But how often are you finding your companies getting taken out? Like, especially post 2021, there was this big trend. Companies were more likely to go private than they were to come public.
Yeah, I think it comes in waves. If you go back to 2020, I believe it was, we had something like 5 takeouts in the portfolio that year. And when you only own 15 or 20 stocks, that's a lot. But then you go through, last year, I think we had 0. So I think it kind of comes in waves. And a lot of people, some people will invest in stocks just purely on that speculation. We won't do that. But because of the quality of the stocks we own, and they tend to be really high growth, high margin stocks that are cheap, they tend to attract buyers. So it is something that happens. I'm actually usually not that happy when it happens, and that might come as a surprise to you. But the reason I say that is a normal takeout premium would be, let's say 30%, maybe 40% if the stock's, really beaten down, maybe a little more. If we're buying companies that we think can grow 20 or 30% a year, all we're really getting is about 1 year's growth up front when we get that takeout. And again, what we're looking for is so specific that I have to now go find another company that looks like that. So sure, I'm happy to take the pop and take the win, but a lot of times they're companies I actually don't want to say goodbye to.
Good perspective. We're going to take a quick break and we'll get back into the mailbag after this. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, welcome back. Our next question here is about Zedcor. I hold Zedcor for the long term and would like to add more. Do you recommend buying it at current levels? This one coming from Bill in Duncan, BC. This is a security company?
It is. So they've got security towers that are used to monitor things like big box retail or construction sites. Picture a big tower with lights and cameras that's monitored remotely, and that would replace a traditional security guard. So think of a traditional security guard who's paid by the hour. This is a much more cost-effective way for these customers to get the security that they need.
Okay. So a camera on a stick.
Yes.
And the stock has been extraordinary.
Yes.
Help me understand why that's such an exciting business.
So I probably fall a little more in your camp, but I'll give you the street view and kind of what's happened. And just for the record, we don't own the stock currently. We were in early and we were out pretty early. So I sold this one too early. We made a really nice gain. I think the valuation right now is quite a bit stretched for, especially as you said, a product that, if you think about it, is pretty easy for others to come in. And we actually saw that last week with a Toronto-based company called Avante, which is a public company launching a competitive product and actually stealing, I don't know if he was head of sales, but one of the business development people from Zedcor to come in and run the business.
So I'm glad you brought that up because we have a question. Our next question is about Avante.
Okay, so
this
we'll go there
is from
next.
AJ and X. Yeah, let's finish on Zedcor.
So the stock's had an incredible run. I think they've gone out, they've definitely executed well. They've continued to bump their production of towers, and they've continued to get customer wins, particularly in the US. And I think the street got very excited because they went out to investors and laid out a pretty aggressive growth plan. And it's one of those businesses that's pretty easy to analyze because you can sit there and once you understand the economics of one tower, you can say, okay, they're going to do X number of towers next year, and that would produce A, B, and C, and that's all great. The problem is whenever you have what I'd call a relatively simple business where competitors can come in and squeeze margins, so they can say, okay, Zedcor is charging this, we're going to do it a little bit cheaper, we're going to get some market share. There could be other competitors that are coming in as well. And this was one of my concerns with the stock, like you said. The second thing is just valuation. I mean, the valuation, I don't know the current market cap now, it's probably in the neighborhood of 300 million, give or take. Just to backfill the current valuation they have needs a lot of growth. And this is leads into a conversation I was actually having with someone who runs a desk that covers the stock yesterday. If you look at the stock on EBITDA or if you look at the stock on earnings, it's going to tell you two very different stories. And most of the street looks at EBITDA. We generally don't. And
why?
That's, well, long conversation, but if you go back to what Buffett talked about, he called EBITDA bullshit earnings. That was his term for it. And I recognized early on that if you have a company, let's say it's a trucking company and trucks depreciate, but when you look at EBITDA, you're going to add back the depreciation. And that trucking company might also have debt. They owe the bank. So, and they have to pay interest. The last time I checked, banks like getting paid their interest. So all of a sudden we have a trucking company. We're going to ignore the depreciation on the trucks. We're going to ignore the interest that they're paying on their bank debt. And then we're going to ignore taxes too. And I think most companies, unless they have tax losses, have to pay taxes. So I understand the use of EBITDA if you are, let's say, an investment banker and you're trying to neutralize a capital structure because you're looking to compare two companies in that way. Generally, I find EBITDA to be not very helpful. And this is a case where these towers depreciate. So if you ignore that depreciation on an EBITDA basis, it might be at, I'm just going to guess, I haven't looked at the number in the last few days, maybe 15 times EBITDA. But if you look at it on an earnings basis, the PE is going to look astronomical.
150. I don't have the multiple on EBITDA, but on earnings, it's 150 times.
Right.
Earnings, and the market cap is around 300 million.
Right.
Okay, enough said. Let's bring that to Avante then. What are your thoughts on Avante and their tower segment of the business? They recently hired a former Zedcor sales leader. This is coming from AJ on X. I mean, boy, considering these are underfollowed stocks, our viewers know a lot about them.
Thanks for the question, AJ. So Avante's been around a long time. It used to be more of a traditional security business. And in fact, they had a specialty doing high-end security. You might have seen their cars driving around in Toronto where they'll go and at night they'll go and check and make sure your door's locked and your car's door's locked and all that stuff. And that business is okay. But typically security businesses, when you're paying a guard, let's say $20 an hour, and then you're billing them out at $24 an hour, it's not a great business. Like you really have to do a lot of volume, and there's some big players in that business. So I looked at Avante, the old Avante, in the past. They recently had a CEO change where the founder came back in and took over. They're actually located right near here. So I used to see the old CEO walking around at lunch all the time. I took a fresh look at it. Obviously, they're launching this new business to compete with Zedcor. I think astutely, they looked at the multiple that Zedcor was getting and maybe made the same judgments that you made about their ability to produce this product and said, we're going to go get into that business. So it's very small. They've got a very small number of towers currently. So for me, that one's a wait and see. But if you really think that they're going to be able to scale that and it's going to get the attention that Zedcor gets, then maybe it's something to look at.
I guess I just don't understand. You have the tower. What if somebody's doing something wrong? Don't you still need a body there? Or is somebody remote that's
so they're remotely monitoring and then they'll alert police.
Let's go to our next question. This one is on Ag Growth International. What are Jordan's thoughts on AFN, which is Ag Growth International? This question coming from James.
Sure. So we don't own the stock currently. The stock's had a bumpy ride. If you remember last year, there was a takeout offer at $60 a share, which the board said no to. I'm guessing some people probably wish they would have made a different decision. This is a company that we had a small position in probably about a year ago, and they've really struggled more. This is a company that has business in a lot of different geographies, and then they also have a farm segment and they have a commercial segment. The farm segment is really struggling. That farm business has been really slow. Last year's results weren't great. They just took their guidance down again and basically said 2025 is going to be soft and that, you may see a recovery into 2026. I don't really like businesses where I know the next year is going to be bad. I mean, they're essentially telling you that. Plus, this is one of those companies where the results are really good in some years and then they're not so great in other years. I want that consistency. I want that ability to say, I think this company is going to grow by 20+% a year and have that conviction that they're able to do that. I just don't have that on this stock, which is why I don't own it.
Yeah, so they said no to a $60 buyout. Yeah, the stock's trading at 35. So I'm sure there's enough regret to go around. Okay, we got so many questions on this last stock. Enterprise Group. Pipeline construction company, this one coming from Evil Genius 39 on X. I want to believe in Enterprise Group. The stock has pulled back. What's going on here?
So this dovetails nicely into what we were talking about earlier about these tech-driven oilfield services companies, because I didn't really know much about Enterprise till about a year and a half ago, and somebody showed it to me, and I looked at it, and I looked at the margins, and I said, what's going on here? These margins are way higher than I would expect because...
So they do pipeline construction?
So their traditional business is the type of equipment you'd see on a site. So lighting, those bumpers that trucks drive over, things like that. So solutions to help go in and help facilitate the site to run properly. And then a couple of years ago, they started a power division. And the power division the idea was that they were going to buy these natural gas generators that can be used to power drilling sites. So usually you'd have diesel generators on a site, and they were able to come in and secure this distribution for this product that was a natural gas generator, which there were really two key things. The customer would save a ton of money because they're way cheaper, and they're also way cleaner environmentally. So it helps with things like the carbon credits and all of those things. So,
and you were saying the margins on the
right.
overall business were huge.
So what I realized after I started talking to the company and understanding what they did is the margins on the traditional business were actually normal. It was this power division that was actually really driving these profits. And I think because the margins are so good, the company hasn't really told the market explicitly in writing what the margins are because of competitive reasons, obviously. But this business has been growing really, really fast. And if you looked at, I think it was about 3 or 4 quarters ago, like the margins were just insane and the stock went on a big run. And I was talking about it on BNN. They were getting out doing some marketing. Some brokers got interested. And then we had a bit of a hiccup lately because their Q4 was weak. And I think the entire oilfield services had a weak Q4, mostly because of LNG Canada being pushed a little bit. So I think everybody thought phase 1 of LNG Canada was going to come in the back half of 2024. It's kind of been pushed into 2025.
This wasn't just a bump in the road, though. The stock has been cut in half in about a month and a half.
Sure. I mean, I would probably say it shouldn't have been at $3 to begin with. So it's trading on a much higher multiple than the other OFS stocks that we own. That being said, this power division is growing very, very fast. And I think it's a very desirable business that, going back to what we talked about earlier, the management team's been at this for a while. They're in their 60s. I don't think they want to stay around for another cycle. So in terms of all the names we own, this one would also be on my takeout candidate list. Maybe not today. I think you'd have to scale the business to about $100 million in revenue. But with their power division and these turbines, I think they're going to get there pretty quickly. And lastly, the company just raised, I think it was about $25 million in a financing that was well oversubscribed. They haven't put that money to work yet. So I think you need to be watching closely because I don't think they raised that money for nothing. And I think the use of proceeds, we'll see when we see what they end up doing with it. But I think you're going to see some pretty exciting news out of these guys. And I also think you're going to see some big Q1s out of oilfield services, just given what happened in Q4. These are lumpy businesses. These aren't like some of the other companies I talked about where you get that nice steady earnings every quarter. You're going to have contracts that are delayed. You're going to have things that may come in and out of quarters. You're going to have weather issues. So these are ones that are hard to just own for a quarter or two. You have to kind of take a position. And with Enterprise, I think it's probably more, and McCoy, I think it's a 2026 story. So if you're an investor who wants to trade around quarters, these stocks aren't for you.
So does that mean are you prepared to endure a 50% drop in a stock in a couple of months? Does that come with the territory?
It does, because also with small caps, when you get really tight floats, and you get that sometimes in small caps, because a lot of them are founder-led companies where the founder might own 30 or 40 or 50% of the business, and then the rest of it is in a small number of hands. Well, if you get a seller all of a sudden, and they may not even be selling because there's something wrong with the business, there may be something else going on. Maybe it's a fund that's having redemptions and they need to sell positions. We get calls all the time where there's been a manager change at a fund, or maybe, like a fund is closing and they have to sell off stocks. So there's a lot going on behind the scenes. And I think what retail investors have to remember is, you can't just pay attention to price action. If all you're paying attention to is price action, you're going to get whipsawed around like crazy, because you're going to come in the morning, you're going to open your computer, you're going to see a stock down 10 or 15%, and you're not going to know why. And the thinking is something's wrong. And something might be wrong. But like I said, it could just be a seller that's moving off a stock, and then you panic sell. The next day, the seller's done, and the stock's back up 15 or 20%, and you're getting whipsawed. Right? So small caps are a little bit different than large caps in that the liquidity profile is different, the trading patterns are different, and knowing how to trade them is a skill in and of itself. I think a small cap manager actually has to be a good trader, whereas a large cap manager, obviously they need to time what they're doing, but a large cap manager can buy or sell the securities. I was talking to a friend of mine who runs a very large cap portfolio, and he was telling me, like, if he's not feeling so good about the markets on a Friday, he'll actually liquidate most of his portfolio and buy it back on Monday. And the trading costs are so low now. And if he's not worried about tax because maybe it's a pension or whatever it is, these guys will act that way. I would never go and liquidate my portfolio. Do you know how long it would take me to rebuild some of these positions? I mean, some of these positions takes months, if not years, to build.
All right. That's super interesting. Yeah. Okay, Jordan, let's get into your pro picks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, everybody has probably been screaming this whole show and being like, when is he going to talk about Propel Holdings? For some reason, you are the box on Propel Holdings, which is another one of these online lending platforms, and this is your first pick.
Correct. I think we've been talking about Propel both on BNN and in our writings since the IPO in 2021. So we've owned the stock since then. It's been a fantastic winner despite the recent share price performance, which we'll talk about. It's an incredible business. I don't know how much you want to get into what they do versus, what's happened lately with the stock.
Well, let's do both. We got time.
Let's do both. Okay. So unlike GoEasy, that actually has physical branches and does a bunch of different things like credit cards and auto financing, Propel's focused exclusively on consumer lending. So most of their businesses in the US, they've got a small business in Canada called Fora that competes with GoEasy because, as you may know, Canada has interest rate caps now at 35%. Most of the businesses in the US, so it's US consumer lending, but it's online consumer lending. So they don't have any physical branches or anything like that. It's all done online, and it's done through technology that they've developed internally over the last 13 years or so. Toronto-based company, listed in Toronto, growing like crazy. They just bought a lender in the UK, so they're now going to do the same thing over there. So you've got Canada, the US, and the UK, but US is really the majority of the business.
So a lot of 2021 IPOs, they went up and then they came down. They either never came back, they're still struggling, or they've been bought out. Propel is not that. Propel went well above where it debuted in 2021. And even though it's pulled back huge, it's still above those levels. I want to know, why did it pull back so much? I'm just going to make my numbers on my chart on my Bloomberg, and it's lost 50% in a couple of weeks.
So this goes back to your question before. So let's go back to the beginning, which lucky for us is not so long ago. It's 2021. So company comes out. I think the IPO was $9.75 a share, if I'm not mistaken. We participated in the IPO. It was a really hot market. If you can remember Q4 2021, we were seeing a ton of financings. The market was ripping. Everybody was making money. Stock quickly went to about 14. So we bought a little bit on the way up. As I described to you earlier, we kind of like to buy as stocks are going up. So we buy a little bit on the way up. So we had bought some at $9.75. We had bought some around 11 or 12. It hits 14. Everybody's happy. Our cost base is probably 11 or whatever it is, 10.50. And then we get the 2022 market, which was not kind to equities. It was not kind to small caps. And really, regardless of the quality of the company, stocks were being sold down. So all of a sudden, the stock went from 14 to 6. And I distinctly remember the fall of 2022, looking at the company and really scratching my head because the operating performance had been great, but the stock went from 14 to 6. And at the time, on my numbers, I was going to buy the stock at about 3 times earnings at $6. So this is 3 times earnings. And this company had been doubling profits every year for the last 3 years. It had a dividend. There were no issues with the company. And I'm getting calls from brokers every day offering me blocks of stock, 50,000 for sale, 100,000 for sale. So we start buying a lot of stock, and actually becomes our largest position in the fund in 2022. And I'm wondering why nobody wants to own this stock except for me. Me and maybe a few others. And then we get into 2023 and the markets start to rebound. And through 2023 and 2024, the stock went from 6 to 43.
Wow.
Okay. So it went on a huge run. And basically what happens was, going back to our earlier conversation about multiple expansion and getting into these stocks when they're trading at low multiples, the multiple went from 3 to about 11 or 12 at its peak. Okay. So up to about a normal multiple in that $40 to $45 range. Now I'll get to your question. So what's happened since then? Well, people have gotten concerned about the economy. People have gotten concerned about the consumer. I still don't think people totally understand this business. And I think part of the reason is Canadian investors love their banks. I've talked about this a lot before. They love their banks. They love their insurance companies. Usually their equity portfolios are full of those.
They don't drop 50% in a few weeks.
Sure, but they also don't 5X in a year. So where do you want to be, right? Do you want to own? You probably want to be in both places. But getting back to the conversation, people get worried. I think people are so full of financials that there's not a lot of players even looking at these stocks to begin with because of just the market structure in Canada. But there's some amazing companies that you can find in these non-bank financials, these niche lenders, okay? So people get worried about the economy. People maybe don't understand Propel's business entirely. I know some people called and asked me if there were tariff issues. There's no tariff issues. They're a US lender. They don't actually make anything. These are loans, but it just goes to show you the things that people worry about. And then I think there was also been a lot of faster money in the stock that has been playing quarters. So I think what might have happened, and I have no way to confirm this, is you had some people who were coming into the stock for the quarter, Q4. The quarter was good, but the stock didn't move. So now these fast money players will exit. And what happens is then that will set off some of the machines, the algos. Then that will upset the retail investors who all of a sudden are looking at a stock that's down 20 or 30%. So now they're selling. And going back to what I was saying a few minutes ago, they're responding to price action without actually looking at what's going on in the company. If you look at the Q4 earnings release, the numbers were spectacular. And the guidance for this year is also spectacular. This company is giving guidance for a 30% return on equity. I don't think there's many companies, if any, in Canada that are doing that. So we have a very high growth company that's operating in a very large market, just in the US. Now we have UK and Canada as well. You've got a nice balance sheet. Right now, their cost of funds is a little bit high. They're working on to drive that down. So that'll be another catalyst. They've raised their dividend, I think, 6 times in the last 4 quarters. What I've said before about this company is it's something for everyone. If you're a growth investor, it's got a very high growth profile. If you're a value investor, you're buying the stock right now on 6 times earnings, okay? If you like dividends, it has a dividend. So there's a little bit of something for everybody here. I love this company. I think you're going to see over time, and you can, hopefully we're still doing this podcast in 3 years or 4 years. I think this is actually a $100 stock.
Okay, what's it at now? 23?
23. And I'll tell you quickly how we're going to get there. Right now is about $4 a share of earnings. If they can continue to grow at 30+% a year, if you do the math, in 3 or 4 years, that gives you about $10 a share of EPS. Put a 10 times multiple on that. This is a $100 stock. I think we're going to get there. Unless something crazy happens, we're going to hold the stock until then. And let's talk about it again in 3 or 4 years.
All right, we're going to do that. I'm going to hold you to it. Let's go to your second one. The second one is Source Energy Services. It's an energy services company, swung to a loss in its most recent quarter in February. And I think that's when the stock pulled back.
Yes. So this is another kind of interesting business that, I probably wouldn't have ever thought I would have owned something like this if you would have asked me 4 or 5 years ago, but somebody showed it to me 2 or 3 years ago. I didn't think I would like it. They're a frac sand company. So they're one of the leading providers of frac sand in Canada. They mine the sand in the US and Canada, and then they sell primarily to Canadian large E&Ps, names that your viewers would know. And at the time that I saw it, what kind of intrigued me was during COVID, there was no drilling. So sand prices collapsed, and they have fixed price contracts with their customers. So they were writing these contracts at very low prices in 2020. By the time I saw it in 2022, those contracts were rolling off, and they were getting renewed at basically double the price because drilling had come back. So all of a sudden you had a company that had a cost structure that was kind of, flat where it was, but they were about to be able to sell their product for much more. So I was kind of intrigued. The reason nobody really was looking at this is it was really small. When we bought it, it was only a 30 million market cap. So it's one of the smallest companies that we've ever invested in. But at the time, they had about 100 million of EBITDA. So think about that for a second. And we were just talking about EBITDA. I'm using that metric just because earnings wouldn't tell you the exact same picture. But we were looking at a company where sand prices were going up, and they were renewing these contracts at higher prices. They were about to start paying down debt, and no analysts were covering this thing. And I thought, this is kind of interesting. So we bought a little bit of stock down around $1.60, and over a year and a half, it went to $16. So it was actually a 10x for us. So you talk about the returns that you can get in our corner of the market. The reason you're willing to accept 50% drawdowns is so that you can get returns like that. So that being said, They had a soft Q4, like a lot of the other OFS companies. I think Q1 will be very strong because I think some of the business that we should have seen in Q4 will be coming in Q1. I think you're going to see the company buying back stock. They also did a JV with Trican last year, which is interesting. I think a lot of the companies like Trican have cited frac sand as a bottleneck in their process, and securing a supply of sand is very important to them. Ultimately, I think this is another one that could get taken out. We don't own it for that reason.
Who would be a buyer?
You could see an oilfield services company that just wanted to make sure they had supply for their customers. There was a transaction. This one was really interesting in the US last year. Apollo, the private equity firm, bought a company called US Silica. And just to give you some metrics, at the time I did some math and I said, okay, if we took the multiple that Apollo paid for that company and put it on Source, what's the share price? It was over $30.
And right now it's 10. I love when you do the math for us.
You like that?
Take it through, but give me the answer too. Let's go to your third pick. This one is Mainstreet Equity. This is an interesting one. It's real estate exposure, but it's not a classic REIT. Help us understand what Mainstreet Equity is, how it's different.
Again, probably not a stock I would have thought I would have owned. I never buy real estate stocks because most of them are REITs, and most of them take any of the cash flows they have and they pay them out to their unit holders, and they tend to raise equity quite often to finance operations. So usually not the kind of company that screens well for me, and not the kind of company that really has what I'm looking for. So the CEO came into my office, I think in around 2020, was actually coming in for a different reason, but started talking about Mainstreet and what he was doing. And I had never even looked at this company. The first thing to realize is this is not a REIT, it's a corp. It's a corporation. So that's the first key difference. The second difference is they're not actually paying out their cash flows. They recently started a small dividend last year, but it's minuscule. And I think it's mostly just so they can be included in various funds that require companies to pay a dividend. But what the CEO, his name is Bob Dylan, has done over the years is he's taken the cash flows from his business and he's used those cash flows to buy more buildings. So it's a Western Canadian focus. So they're not in Ontario or Quebec. The good thing about Western Canadian provinces is they don't have rent control like we have here in Ontario. So if you're going to be in the apartment building business, it's better to be in the apartment building out west as opposed to here.
That's interesting because we hear a lot about the sluggishness in the condo market and units that are not selling, and REIT CEOs saying there's now deflation in rents. Is that not happening out west?
No, because the up until recently, the economies have been doing quite well. I visited their offices last May, and I had a chat with them about rental increases. And at the time, rental increases, when a tenant was moving out, they were raising rents at least 10%. So the interesting thing about this company is they were raising rents, and at the same time, the vacancies were going down. So when we first invested, the vacancy rate the company was reporting was about 7%, I think, across its whole portfolio. We saw those numbers go down to about 3%. So you had rents going up, vacancies going down. So the tailwinds were very strong. The most interesting thing about this company, though, I have to say, is they never raise equity. So they've been public for over 20 years. Their shares outstanding is the same as it was then, but the stock's gone from $1 to I think around $180, $185 today. It's been a huge Canadian success story, going from 200 apartments to almost 20,000 apartments.
And again, not through raising equity,
exactly.
Not paying the dividend.
No dilution.
Taking that cash and putting it back into the business. So on a very long term, it's done super well. Recently, it has pulled back. And we actually did a show on REITs, and the fund manager, Dina Rico at Middlefield, was saying the gaps between what these REIT stocks are trading at and the value of the assets that they hold are huge. Is that the same then for Mainstreet, or does it not really work that way?
It works the same way in theory, in that you have to look at the NAV and look at the share price and figure out if you're at a discount or a premium, and they do typically trade at a discount for a whole bunch of reasons. Mainstreet has actually, since I've been following it, usually traded at around a 10% discount to NAV, but then we did see periods, there was a big run in the share price last year where it was trading at a premium to NAV. So we've seen it kind of ebb and flow. Right now, I have it trading at a pretty large discount to NAV. So our NAV on Mainstreet right now is $253. That's based on 2026, our estimates of 2026 NOI, net operating income is how we come to that calc. people can do those calcs different ways. They can include or exclude certain types of debt. There's different ways to come to that number, but our number right now is $253. You have a stock trading at $183, $185. So again, if you don't own it, I think this is a great steady Eddie. And I actually said to Bob, the CEO, out of all the companies we own, this is the one I worry about the least. These are apartment buildings, and these are kind of, mid-market apartments. So these are not $10,000 a month penthouses. These are apartments for everyday Canadians. A lot of them are new Canadians. A lot of them are students. But one of the things nobody talks about with this business is there's a lot of hidden upside. And I talked about this a little bit on BNN last time, but we have the core apartment portfolio, which is great, and it throws off all this cash flow, and it's really well managed, and that's kind of the core business. But we have a big problem in Canada with housing, and the problem is density. And the way that various cities and municipalities are dealing with this problem is by relaxing density rules. And we've seen this in Toronto. We've seen super high condos and things like that coming up. You haven't seen that as much in Western Canada. So if you think about what Main Street owns, these are mostly small apartment buildings located in downtown Western Canadian cities. So I think you probably know where I'm going with this, which is a lot of these could be condo sites. And as a condo site, they're worth a lot more than they're worth now as apartments. So there's potential for these buildings potentially to be turned into condos. That's the first piece. The second piece is a lot of these properties have excess land. Could be things like an external parking lot or things like that. So one of the things the company is exploring is actually severing the land within the portfolio and being able to either sell off those pieces or do joint ventures with developers to do construction on those pieces. The last piece to the puzzle is the company's also very good at adding units to existing properties. So they might convert a swimming pool or a laundry room or things like that. So there's a lot of other drivers over and above this kind of core business. So what I think is, just the core business itself is a really good business to own. And then if you get over the next kind of 5-10 years, this sort of blue sky scenario where you start seeing them doing other things with their properties, I mean, I don't even want to tell you how much it would add to the share price because I just don't. You
have to tell me.
I just don't. Let's just say it would be very material. And if you're going to own a real estate stock in Canada, we only own one. This is the one I think you want to own. It's very well run. CEO owns half the company. So if you talk about alignment of interest, and he's never sold a share, that is what you want in alignment of interest.
All right. We're going to end on that definitive note.
All right.
Jordan, thank you so much for joining me.
Thank you.
And thank you to everybody for listening. Now, these were smaller companies, so what we're going to do is put the tickers in the show notes as well so that you can do your own research on them, should you wish, or call up Jordan at Bedford Park Capital. Don't miss the next show. We've got Dan Rohinton. Now, he likes those large caps, and he's going to tell us which one he prefers. He is portfolio manager at IA Global Asset Management. You can find us anywhere on social media. Get your questions in, questions at inthemoneypod.com, or find us anywhere on social media at In the Money Pod, and we'll see you on the next episode.